Welcome to Realizing Real Estate. Each week we will be issuing a new edition, an interview with an investor, developer, business leader, government official, scholars, and others, all who in some way impact the world of real estate and the quality of your investment. Real estate has many facets. We will explore many of them in these brief podcasts. Every one of our guests will be interviewed in greater depth and length on our weekly radio show, Our House, which is broadcast every Saturday at 9 a.m. on WBN 9:30 a.m. and 98.5 FM HD3 in the Buffalo Niagara Marketplace, but is accessible anywhere in the world on the Odyssey app or at WBN.com. All of Realizing Real Estate podcasts are available at the iTunes Store, and our House radio shows are archived on our blog at huntrealestate.com. Join us every week and give us your feedback and suggestions for future topics, also at huntrealestate.com. Welcome to Realizing Real Estate. I'm Peter Hunt, and my guest today is Glenn Arthurs. Mr. Arthurs is the Managing Director of Wealth Management and Senior Advisor and a Senior Portfolio Manager for UBS Financial Services based in Buffalo, New York. Good morning, Glenn.
Good morning.
Didn't mean to surprise you there. Anyway, we're here today to explore, I guess, in a broader sense, many of the things that impact our world of real estate and really all of our worlds when it comes to financial services and what's underlying, what's the activity underlying the conditions in our economy today. You know, we've talked many times, Glenn, about the key factors in your analysis of the world and in terms of how you may advise your clients, as well as those key factors that impact our business. And to boil it down into kind of two things. One would be the actions of the Federal Reserve, and the other one, which is, at least this is my theory now, which would be the national debt, which impacts to a large extent the yield on bonds so that the government can raise money to effectively pay debt and to pay interest, for example. Let's start with the Federal Reserve. This week, there was a decision by the Federal Reserve Board to not increase or decrease rates when there was widely anticipated that would happen. But as they look to the fall, they are anticipating that the Fed will act to reduce rates. What are your thoughts on this, and what do you think the Fed may do, and why would they do it one way or another?
Well, the Federal Reserve has a dual mandate. One is to maximize employment. The other is to provide stable prices, which is an inflation target these days of 2%. So right now, we're somewhere up in the 2.75% to 3%. In general, we had a recent meeting with the Fed, and we had the decision to not do anything at the present time to monitor and evaluate what's going on with the economy and tariffs, and they will focus on this in the September meeting. Investors had been hoping that the Fed would provide greater clarity to say that they were going to do something in September, which they declined to do, but we had two governors dissent, which is an extreme rarity in the Federal Reserve. That hasn't happened in over 30 years. Both of those governors were recent Trump appointees, and they're pushing for lower rates. It's likely that that's going to happen as we roll towards September and the fall. UBS, as an official policy, believes that there's going to be 100 basis points cuts in the next 12 months, probably focusing on September and December. Today, we had jobs numbers that came out. The jobs numbers were 73,000. Forecast had been somewhere around 110,000. All of those jobs numbers had occurred in the services industry, the healthcare services, and social assistant industries. That's not a good jobs report. That will probably put greater pressure on the Fed to drop rates as we go towards the fall. The fear is that we could move towards stagflation. And stagflation is a condition which is extremely undesirable. It's defined by having a stagnant economic growth, high unemployment, and high inflation, none of which are particularly attractive. So one of the tools that the Fed has is to be able to drop rates. The reluctance to do that so far has been the uncertainty associated with the tariff policies. and how that will ripple through the economy.
It's interesting. Last time we had stagflation, as you mentioned, was really of any consequence was in the 70s. It's been a long time since we've had stagflation. At that point in time, the impact on real estate, which was very interesting, it wasn't good. We had a large increase in inventory, but right before that happened, we had a severe inventory shortage. In other words, listings were very hard to come by in our industry, and buyers were plentiful, demand was high, and as a result, we saw inflation of real estate values. So the inflation part of stagflation was readily apparent in real estate, but that changed as the economy stagnated. It changed in that it took longer to sell a house. Buyers were reluctant to buy in a market like that because they were very concerned about the future, obviously, and the value of that home. Right now, we're in a situation in real estate where prices continue to rise. Believe it or not, nationwide, we have the highest average sale price we've ever had by a considerable margin, somewhere north of $430,000. We also had a prediction, which is kind of interesting, that was lower than, on an annualized basis, that the prediction for sales in this country this year would, in a rolling 12-month basis, would be less than 4 million units per year. The peak was 6.12 million existing home sales in 2021. I don't think we're ever going to see that again, and it's largely because, well, we won't see it again until interest rates are ridiculously low.
Mm-hmm.
Do you see any way, for example, going back to the bond market for a second, do you see any way that bond yields could come down, particularly for the 10-year T-bill, which you've commented on in the past as being kind of the benchmark yield, benchmark measure, for example, on for example, mortgage rates, et cetera? Do you see that there would be any circumstances that would create an environment where bond yields would get down to where they, like for 10-year yields, about 4.4, something like that right now, that they would get down to 3? Is that possible in your mind?
I'm not sure that we're going to 3 on the 10-year United States Treasury. Think of the 10-year as the North Star of the bond market world. Everything is priced off that on the longer end. Obviously, the Fed controls the short end, which the Fed funds rate are currently 4.25 to 4.50. With the dropping of rates as we move out through the next 12 months, I can see that the longer rates, the 10-year Treasury, has the potential to start to decline. And that would be enormously positive for real estate, small businesses, the mid-sized businesses. It's the cost of money that's going down. So yes, I see that as a possibility. I think UBS has a target on the 10-year Treasury 12 months from now being somewhere in the middle to the high 3s, which is distinctly lower than where it is right now. But the fear is that will the tariff disruption ripple through? Will foreign investors continue to buy United States Treasuries? Will the dollar maintain its value? The dollar has dropped precipitously this year because of all the uncertainty associated with that. But the dollar is still the world's reserve currency and will continue to be so for the foreseeable future.
It's interesting. I'm shocked that UBS, being what it is, would size that it is, and that's a Swiss-based organization. Is that correct?
Yes.
That their worldwide presence, that they would suggest that we could get into the 3s. I frankly don't see that. I hope, and I pray you're right, and I hope UBS is right, but I don't see that with the national debt the size that it is, and the need to fund that debt, that isn't going to go away anytime soon, and the projection for more deficits at the national level, and for the state and local level, for that matter, that bond yields could go down.
Well, again, the Fed is going to be the key to starting that process. And
but the last time that happened, the Fed lowered by 100 basis points in 3 drops over just a 3-month period of time. Those 3 drops preceded exactly the opposite effect in the bond yields. They went up.
It did, but that's not normally how that will go.
They usually track together.
And the curve is usually, shorter rates are at the curve is an upward sloping to the right with longer rates being higher. That's a normal world. We got into a situation where you had an inverted curve for many years where short rates were higher than long-term rates. That has changed now, and it works a lot better if you have, you would expect if you go out longer on a curve to buy U.S. bonds that you would get a higher rate of return for the longer that you go out.
Let's close with just your perspective on the positives and negatives that we may be experiencing in the financial world over the next, say, 6 or 8 months.
Well, if I look out, supply demand with regard to stocks, there was over 8,000 publicly traded companies 25 years ago. Today, there's 4,000 publicly traded companies. It's been consolidation, merger, but it's also the regulatory burden of being a publicly traded company is immense, and many companies have chosen to go the private route. There's tremendously more money circulating out there. So you have more dollars. It's estimated there's somewhere around $6 trillion that's sitting in money market. Much of that money would like to be into the stock market, but there hasn't been a breather in the market for quite a while.
In terms of an upward slope.
In terms of an upward slope. So that money would like to get into the market and probably will come in if there is any significant short-term aberration or pullback in the market. If you look at the positives in the market, we've got AI efficiency and initiatives that are being stimulated out there. The administration is trying to speed up the adoption of AI infrastructure. You also have favorable tax policies, or taxes aren't going up in the short term as a result of the most recent bill. You've got the potential for rate cuts that are coming in the next 12 months. That would be stimulative to small, mid real estate. That would be tremendously stimulative to the cost of money coming down. There's always negatives out there, so I don't mean to say that everything is all rosy. The tariffs are an unknown. It's a situation that we haven't really encountered before. I mean, the last time they did this in the 1930s, it didn't end well. This is a different environment, a different climate. So far, the tariffs haven't disrupted the stock market here, but there's uncertainty there.
By the way, just let me interrupt for 2 seconds. This week alone, they said, one commentator said that the average now, post-Trump moves in terms of all the nations that he issued on August 1st, that these are all the things that, these are going to be the rates at all the various countries. The average is 13%, which is actually somewhat lower than it has been in the past, on average, across the board. So the fears of tariffs will be, I think, largely based, or the negative effect will be largely based on the individual country and what products or goods or services are going back and forth. And the extent to which that companies in this country, based in this country, are buying things overseas to manufacture something here or vice versa.
Well, that's very true, but it's a different policy that's been pursued in the past.
But hasn't that been overblown, really?
Well, yeah. And
in terms of the negative side of it?
On the negative side, it has been so far, and that's why the market has had a tremendous rally. And there's also a lot of money that's being brought back to the United States in terms of infrastructure investment that it's going along with the tariff policy. There's been, it's been articulated that there's been a surplus in many of these countries that have trading surpluses with the United States. And, much of the tariff negotiation has been to try and structurally change that so that money is flowing back to the United States. Money is going in terms of capital expenditure.
Well, there's so much that we could unpack and all that, and we don't have the time to do that. But in our last minute or so here, just say a little bit more about where you think the next 6-8 months, what will really look like here, not just nationwide or worldwide, but right here in Western New York. What are your thoughts?
Well, national and Western New York, two different things. Western New York, you always hope for the best. There was a beautiful article today in today's Wall Street Journal that had talked about real estate in Western New York and all the attractions and things that are tremendously stimulative. It's great to see. I'm hopeful that Buffalo continues on that kind of path. On a national basis, I think that there's the long term is still very solid. Yes, there's going to be short-term disruptions in the market. Valuation probably is considered to be a little high right now. We're at a multiple, if you base it on 2025 earnings and you look at the multiples, you're somewhere up around 22, 23 times earnings. That means if you had $1 worth of earnings, the stock would be valued at 22 or 23. That's historically a little high, but we're also growing. We're having new products, new services, new technology, greater population growth. We're not at a world war right now, even though we have many wars and conflicts going on, so the geopolitical is containable. So yeah, the trend of the innovation in the market should continue to be upward.
On that note, Glenn Arthurs, Managing Director for Wealth Management and Financial Advisor, Senior Portfolio Manager at UBS. Thank you very much for joining us on Realizing Real Estate.
Thank you for having me, Peter.
I'd like to thank all our viewers and listeners. We'll be back again soon with a new episode of Realizing Real Estate. This is Peter Hunt. Thank you very much.